Hello and welcome to ShareScart. My name is Satakshi Pandey and today we will discuss another interesting topic. So India's non-life insurance sector is one of the fastest growing in the world, driven by rising incomes, digital adoption and government reforms, including 100% FDI and simplified product approvals. Non-life penetration today stands at just 0.9% of GDP, against a global average of 4.3%, which means the addressable market is enormous and largely untapped. SBI General Insurance sits right at the center of this opportunity. Established in 2009 as the non-life arm of State Bank of India, the company has grown from 17 branches in 2011 to over 180 branches today, and more importantly, leverages 23,000 SBI Bank branches as bancassurance distribution points, a reach that no private insurer can replicate. In FY26, the company reported a gross written premium of roughly 16,000 crores, growing at 1.6 times the industry rate, with health up to 27%, personal accident up to 40%, and motor up to 16%. It holds a 7.17% market share among private and standalone health insurers and is the number one player in the personal accident segment. On the financials, revenue has grown from 5,590 crores in FY 2023 to 11,243 crores in FY 26. PAT has improved from 184 CR to 553 CR over the same period, and ROE has risen from 6% to 11.6%. These are encouraging headline numbers. However, a closer look reveals a structural concern that cannot be overlooked. The combined ratio, this metric tells you how profitable a company is when it actually underwrites insurance policies. A ratio above 100% means the company is losing money on its core insurance business. SBI General's combined ratio has worsened every single year from 106.7% in FY 2023 to 109.85% in FY 26, a 312 basis point deterioration over 4 years. The company's own guidance acknowledges this, targeting 107% in FY 27, but even that would be still worse than where it started. This means the company's reported profits are entirely dependent on investment income rather than underwriting, which is a fragile foundation. The solvency ratio, which measures the company's ability to pay claims, has also been declining from 2.25 in FY 2024 to 1.90 in FY 26, sitting just 40 basis points above the regulatory minimum of 1.50 in the peer comparison against ICICI Lombard and Go Digit. ICICI Lombard is the clear benchmark, best combined ratio at 103.4%, highest ROE at 17.8%, strongest solvency at 2.67, and despite the largest market cap of 88,000 CR, the lowest PE at 31.9 times. SBI General and Go Digit are at a comparable maturity stage, both growing fast and both relying on investment income for profitability. SBI General's edge over Go Digit is its bancassurance distribution moat and the institutional backing of SBI. The most revealing valuation metric is the market cap to GWP ratio. SBI General trades at 1.6 times versus ICICI Lombard at 2.88 and Go Digit at 2.54, reflecting both the unlisted liquidity discount and the market's skepticism about underwriting quality. On valuation, we use the market cap to GWP multiple methodology, which is widely used for general insurers, starting from a FY26 GWP base of roughly 16,000 CR and a current market cap of 25,747 CR at rupees 1,150 per share. Model 3 scenarios to FY30. The bear case assumes 12% GWP CAGR and a re-rating to 2.2 times, deferring a 21% CAGR and 116% absolute return. The base case assumes 15% growth and a 2.6 times multiple, delivering a 30% CAGR and 184% return. The bull case at 18% growth and 3 times multiple deliveries, a 38% CAGR and 264% return. Even the bear case is attractive in absolute terms, which reflects how significantly discounted the current unlisted price is relative to where the business could reasonably trade. The investment thesis ultimately rests on two variables. First, whether the combined ratio trend reverses. The FY27 guidance of 107% is the first real test of management's execution. Second, whether an IPO occurs within the investment horizon, removing the liquidity discount and re-rating the stock toward listed peer multiples. The structural advantages, the SBI brand, the distribution network, the under-penetrated market, and the regulatory tailwinds are all durable. What remains unproven is whether the company can convert scale into underwriting quality. Until that is demonstrated, the discount to peers is rational. You keep watching ShareScart for more such informative videos.